Most traders chase breakouts, average down losses, and wonder why their accounts bleed. The market doesn't reward hope, it rewards preparation. After analyzing thousands of price charts and operator behavior, I've identified 5 critical errors that separate the professionals from the perpetual losers. These mistakes aren't obvious, but they're destroying your edge every single day. Here's what the smart money never does. For example, notice how the composite operator accumulates while retail traders panic, sell at support. They're committing these 5 fatal errors: trading against the trend, ignoring volume analysis, entering without a definite plan, letting emotions override logic, and failing to study price-volume relationships. Master these principles, and you'll position yourself alongside the informed money instead of becoming their profit source. Let me be perfectly clear. The difference between the professional speculator and the gambler lies entirely in preparation. The successful trader operates like a general planning a military campaign, every movement calculated, every contingency anticipated, every resource allocated with precision. The amateur, he rushes into battle without reconnaissance, without strategy, hoping that luck will favor his recklessness. I've spent years studying the methods of the composite operator, that powerful syndicate of banking interests and large operators who move markets with deliberate intention. Do you think they enter a stock haphazardly? Absolutely not. They've already mapped their entire campaign before placing a single order. They know exactly where they'll accumulate, at what price levels they'll shake out weak holders, where they'll drive markup, and ultimately where they'll distribute to the eager public. You must adopt this same systematic approach. Before risking a single dollar, answer these questions with absolute certainty. What is my entry point, and why is it justified by current supply and demand? Where will I place my protective stop loss to limit damage if I'm wrong? What is my profit objective based on the stock's position in its price cycle? How much capital will I commit to this single opportunity? Without definite answers to these questions, you're not trading, you're gambling on hope and hunches. The market has an uncanny ability to exploit uncertainty. The trader who enters without a plan becomes paralyzed when price moves against him. Should he hold? Should he exit? Should he add to the position? Every tick becomes an emotional crisis because there's no framework for decision-making. Meanwhile, his capital bleeds as he wavers between fear and false optimism. Consider the operator's methodology during accumulation. They don't simply buy low. They execute a calculated campaign. They depress prices through strategic selling, shake out fearful holders with sudden declines, then quietly absorb the supply at predetermined levels. Every action serves their master plan. Their profit isn't accidental, it's engineered through preparation. Your trading plan must be equally deliberate. Write it down. Specify your exact entry trigger, perhaps a spring following a trading range, confirmed by increasing volume. Define your stop, loss below the last minor support point. Calculate your target based on the vertical distance of the preceding trading range, projected upward from the breakout point. This written plan becomes your anchor during market turbulence. When fear whispers, "Sell everything," or greed shouts, "Buy more," you consult your plan, not your emotions. If the plan remains valid, you hold your position. If price action invalidates your premise, you exit immediately without argument or negotiation. The composite operator profits consistently because they never deviate from their planned campaign. They possess the discipline to wait for optimal conditions, the patience to execute methodically, and the courage to abandon positions when circumstances change. You must cultivate these same qualities. Develop your plan with the analytical rigor of an engineer. Execute it with the discipline of a soldier. Review your results with the honesty of a scientist. This systematic approach transforms speculation from gambling into a professional enterprise, one capable of generating consistent profit rather than sporadic, accidental gains that eventually disappear. Remember, hope is not a strategy. Impulse is not a method. Only definite planning yields definite results. The average speculator watches price movement like a hypnotized rabbit watching a snake. Up goes the price, he becomes excited. Down it falls, he panics. Yet he completely ignores the single most revealing element in the entire equation: volume. This is precisely why he remains perpetually confused about the market's true intentions, while the informed operator profits at his expense. Let me explain something fundamental that will transform your understanding of market behavior. Price is merely the result of the battle between supply and demand. Volume is the effort behind that battle. When you analyze price without volume, you're observing the scoreboard while ignoring the actual game being played on the field. The composite operator cannot hide their footprints. Large-scale accumulation or distribution requires substantial volume. Millions of shares must change hands. When you see price advancing on expanding volume, you're witnessing genuine demand overwhelming supply. The operator is actively buying, creating upward pressure through real commitment of capital. This confirms the movement is authentic, supported by powerful interests. Conversely, when price rises on diminishing volume, be immediately suspicious. This tells you the advance lacks support. There's insufficient demand to sustain the movement. The operator isn't participating. Often, this represents a trap being set for the uninformed public who chase price without understanding the underlying dynamics. These false rallies inevitably collapse because they lack the fuel of genuine buying power. I've observed this principle countless times in my years of studying tape action. During accumulation phases, the operator must absorb all available selling without driving prices higher prematurely. You'll see relatively narrow price ranges accompanied by persistent, heavy volume. This volume represents the transfer of stock from weak, impatient holders to strong, informed hands. The price doesn't advance dramatically because the operator is carefully matching every seller, preventing runaway markup before their accumulation is complete. During markup, the phase where operators drive prices higher, volume characteristics change entirely. Genuine advances show increasing volume on rallies and decreasing volume on reactions. This pattern confirms that demand exceeds supply during upward movements while supply diminishes during pullbacks. The operator is encouraging the advance, and other informed interests are joining the campaign. Now observe distribution. Here, the operator reverses their strategy entirely. They need to sell their accumulated holdings to the eager public without collapsing prices prematurely. You'll see wide price swings with heavy volume. The operator is feeding stock to enthusiastic buyers while creating the illusion of continued strength. Price may even make new highs, but examine the volume carefully. If it's churning without real progress, if rallies show increasing volume but fail to extend gains proportionally, you're witnessing distribution in action. The technical analyst who ignores volume is reading with one eye closed. He sees half the picture and wonders why his conclusions prove unreliable. Volume reveals the truth behind price action. It exposes the operator's intentions. It distinguishes between genuine movements supported by powerful interests and manipulative moves designed to trap the unwary. When price and volume align harmoniously, advances on rising volume, declines on falling volume, you can trade with confidence, knowing you're positioned alongside the informed money. But when they diverge, when volume contradicts price movement, regard this as a red flag demanding immediate attention and probable action. This pernicious habit has destroyed more trading accounts than perhaps any other mistake in the entire catalogue of speculative errors. Yet it persists because it appeals to man's stubborn refusal to admit he's wrong. The trader who averages down is essentially arguing with the market, and I assure you, the market always wins such arguments. Here's the cold reality: when your position moves against you, the market is delivering a message with absolute clarity. It's telling you that your analysis was incorrect, your timing was premature, or circumstances have changed. The proper response is immediate acknowledgement and swift action to limit damage. Instead, the amateur does the opposite. He increases his commitment to a losing proposition, compounding his original error with capital that could be preserved for genuine opportunities. Consider the psychology behind this destructive behavior. A trader purchases a stock at $50 per share, expecting it to advance. Instead, it declines to $45. Rather than accepting this 5-point loss and exiting, he rationalizes, if it was attractive at 50, it must be even more attractive at 45. So he purchases additional shares, lowering his average cost. This sounds logical until you examine the fundamental flaw. His original premise has been invalidated by price action. If the stock were genuinely under accumulation by informed interests, it would be advancing, not declining. The downward movement indicates that supply exceeds demand, the exact opposite of conditions necessary for profitable long positions. I've watched the Composite Operator exploit this weakness mercilessly. They understand that retail traders harbor stubborn attachment to losing positions. The operator will deliberately drive prices lower, shaking the tree violently, forcing these weak holders to either capitulate or commit additional capital at increasingly unfavorable prices. Eventually, when the pain becomes unbearable, these traders surrender their shares at precisely the wrong moment, just as the operator completes accumulation and begins markup. The professional speculator operates with entirely different principles. When a position moves against him beyond his predetermined stop-loss point, he exits immediately without hesitation, without negotiation, without hope that it might come back. He recognizes that capital preservation is paramount. That 5-point loss accepted promptly preserves 95% of his capital for redeployment into superior opportunities. But the trader who averages down, he transforms that manageable 5-point loss into a catastrophic 15 or 20-point disaster. His capital becomes imprisoned in a deteriorating position, unable to participate when genuine opportunities arise. He's psychologically married to this losing trade, checking it obsessively, hoping desperately for rescue. Understand this fundamental principle: losses are an inevitable cost of speculation. The professional accepts small losses as routine business expenses. He cuts them quickly and moves forward without emotional attachment. His edge comes not from avoiding losses entirely. That's impossible, but from ensuring his losses remain small while allowing his profits to run. The mathematics are irrefutable. If you risk 1 point on every trade but allow winners to develop into 5, 10, or 20-point gains, you'll profit handsomely even with a modest success ratio. But if you allow losses to expand through averaging down while cutting profits short, you'll face inevitable ruin regardless of how often you're initially correct. The market rewards decisiveness and punishes hesitation. When you're wrong, admit it immediately. Accept your small loss with the emotional detachment of a businessman writing off a failed venture. Then redirect that preserved capital toward positions where supply and demand dynamics actually support your thesis. Never argue with the tape. Never average down. The market's verdict is final. One of the most expensive lessons a speculator can learn is this: the market will follow the path of least resistance, regardless of your opinion, your hopes, or your cleverly constructed arguments about why it should behave differently. Fighting this fundamental force is like standing before an oncoming locomotive and expecting it to reverse direction, because you will it so. The line of least resistance is determined by the dominant force in the market, the composite operator, and their allied interests. When they've completed accumulation and begun their markup campaign, the line of least resistance is upward. When they've finished distribution and commenced markdown, resistance lies to the downside. Your task as a speculator is not to predict where the market should go based on fundamentals, tips, or personal conviction. Your task is to determine where the line of least resistance currently lies and position yourself accordingly. I've observed countless traders commit financial suicide by trading against this principle. They see a stock in obvious decline, lower highs, lower lows, increasing volume on down moves, and they declare it oversold or too cheap to ignore. They establish long positions, convinced they're buying at bargain prices. Meanwhile, the operator is conducting systematic markdown, and these unfortunate souls are merely providing liquidity for informed sellers. Their capital evaporates as the stock continues its relentless descent along the path of least resistance. The reverse occurs with equal frequency. A stock is clearly in markup, making higher highs, higher lows, with volume confirming each advance. Yet the stubborn trader insists it's overvalued, or due for a correction. He sells short, fighting the dominant upward trend. The operator continues their campaign, driving prices higher, and this unfortunate speculator suffers mounting losses as he battles against the prevailing force. How do you determine the line of least resistance? Study the stock's position within the complete market cycle. Is it emerging from an accumulation area with a spring or sign of strength? The line of least resistance is upward, trade from the long side only. Is it showing preliminary supply after an extended advance, with selling climaxes and automatic rallies? Distribution is underway. Avoid long positions and prepare for markdown. Examine the character of price movements. In uptrends, rallies should be vigorous with strong volume, while reactions are mild with diminishing volume. This tells you that demand dominates during advances, while supply is exhausted during declines, clear evidence that the path of least resistance remains upward. When this relationship inverts, when declines become violent and rallies struggle on poor volume, the line of least resistance has shifted downward. The composite operator possesses the resources to drive prices in their chosen direction for extended periods. They're not concerned with short-term fluctuations or your contrary opinion. They execute their campaign methodically, and the market follows their lead because they control the supply and demand dynamics. Your advantage comes from recognizing their intentions and aligning yourself with their campaign, not opposing it. When the line of least resistance is upward, be long or stand aside. When it points downward, be short or remain in cash. Never, under any circumstances, take positions that require the market to reverse its established direction for you to profit. The river flows in one direction. You can swim with the current effortlessly, or you can exhaust yourself fighting against it. The choice determines whether you arrive at your destination successfully or drown in the attempt. Respect the line of least resistance. It's not your enemy, it's your guide to profitable speculation. The greatest obstacle between you and consistent profit isn't market complexity, lack of capital, or insufficient information. It's the enemy residing between your own ears, your emotions. Fear and greed have bankrupted more speculators than all the market crashes, manipulations, and adverse events combined. Until you master your emotional responses, you'll remain perpetual prey for the composite operator who exploits these predictable human weaknesses with surgical precision. Let me illustrate how emotions sabotage sound trading logic. You've conducted thorough analysis, identified a stock emerging from accumulation, established your position at an advantageous price, and set your protective stop. Everything aligns perfectly with your methodology. Then the stock dips slightly, perhaps 2 points against you, and fear whispers insidiously, "This analysis is wrong. Get out before losses mount." You abandon your carefully constructed plan, selling at a minor loss. Days later, that same stock advances 20 points without you, following exactly the trajectory your original analysis predicted. What happened? Your logic was sound, your analysis was correct, but emotion overrode rational judgment at the critical moment. The opposite scenario occurs with equal devastation. You're holding a profitable position, up 15 points from your entry. Your predetermined target has been reached. Your plan says exit and secure profit. But greed intervenes with seductive promises. This could run another 10 points. Don't leave money on the table! You hold beyond your objective. The market reverses, erasing your gains, possibly turning to loss. Greed transformed certain profit into regret and recrimination. The composite operator understands mass psychology with frightening clarity. They know precisely how to trigger fear and greed in the uninformed public. During accumulation, they engineer sharp declines, shakeouts designed to terrify weak holders into selling. These movements have no fundamental basis. They're psychological warfare. The emotional trader, gripped by fear, surrenders his stock at the exact bottom. The disciplined operator absorbs this supply calmly, without emotional response. During distribution, the operator creates exciting rallies, perhaps driving prices to new highs on sensational news. Greed overwhelms the public's judgment. They rush in, buying enthusiastically at precisely the moment informed interests are liquidating. The emotional trader sees rising prices and experiences fear of missing opportunity, FOMO as it's called today, compelling irrational entry at the worst possible prices. Professional speculation demands emotional detachment. You must approach each trade as a business transaction, not a personal validation of your intelligence or worth. When a trade fails, it doesn't mean you're incompetent. It means market conditions didn't align with your thesis. Accept the loss dispassionately, like a merchant accepting that some inventory won't sell at profit. When a trade succeeds magnificently, don't attribute it to genius. You correctly identified favorable supply, demand dynamics, and positioned accordingly. Take your profit without greed, without fantasizing about what additional gains you could have captured. Cultivate the emotional discipline of a surgeon performing an operation. He doesn't become excited when the procedure goes well or panicked when complications arise. He follows his training, executes his methodology, and responds to developing conditions with practiced skill rather than emotional reaction. Develop a systematic approach and follow it religiously. Write your trading plan before entering positions. When fear or greed tempts you to deviate, consult your written plan, not your feelings. If the plan remains valid based on objective price, volume analysis, maintain your position regardless of emotional discomfort. If conditions change materially, adjust according to predetermined rules, not emotional impulse. The market will test your emotional fortitude relentlessly. It will shake you with unexpected violence. It will tempt you with tantalizing rallies. These tests separate professionals from amateurs. The professional responds with analytical detachment. The amateur reacts with fear and greed, ensuring his capital eventually transfers to stronger hands. Master your emotions or they'll master you and cost you everything. Now you understand the 5 critical errors that separate the professional speculator from the perpetual loser. These aren't minor technical mistakes, they're fundamental violations of sound trading principles that guarantee eventual ruin, regardless of how much capital you begin with or how intelligent you believe yourself to be. The composite operator doesn't succeed through luck, superior tips, or market manipulation alone. They succeed through disciplined adherence to proven principles. They enter every campaign with definite plans. They confirm every movement with volume analysis. They cut losses immediately without argument. They trade exclusively with the line of least resistance. And they execute their campaigns with complete emotional detachment, treating speculation as a business rather than a gambling adventure or personal drama. You must adopt these same professional standards if you expect consistent profit. This transformation won't occur overnight. Years of emotional trading habits, hope-based decision-making, and stubborn attachment to losing positions don't disappear simply because you've read these principles. You must practice them deliberately, consciously, relentlessly until they become automatic responses. Start today. Before placing your next trade, write a definite plan, entry point, stop, loss, profit, objective, and the reasoning behind each decision. Examine volume alongside price movement, asking yourself whether the two confirm each other or contradict. When a position moves against you, honor your stop, loss without hesitation or negotiation. Identify the line of least resistance in every stock you consider and refuse to trade against it regardless of how compelling your contrary opinion seems. Finally, approach each trade with the emotional detachment of a business transaction, divorcing your ego and feelings from the outcome. These 5 principles aren't suggestions for improvement, they're mandatory requirements for survival in the speculative arena. The market rewards those who respect its laws and destroys those who violate them. There are no exceptions, no shortcuts, no substitute for disciplined adherence to sound methodology. The choice before you is stark and unambiguous. Continue trading emotionally, averaging down on losses, fighting dominant trends, ignoring volume, and operating without definite plans, and your capital will inevitably transfer to the informed operators who exploit these weaknesses systematically. Or adopt professional standards, trade with discipline and detachment, and position yourself alongside the successful minority who extract consistent profit from market operations. The market is impartial. It doesn't care about your financial needs, your past successes, or your hopes for the future. It responds only to supply and demand dynamics orchestrated by powerful interests operating according to unchanging principles. Study these principles, practice them faithfully. Respect the market's verdicts without argument. Do this consistently, and you'll transform yourself from an emotional gambler into a professional speculator, one capable of achieving the consistent profit that has eluded you until now. The knowledge is before you. The decision is yours. What will you choose?